Rising treasury yields/bond values puzzling investors. When treasury yields rise, existing bonds with lower coupon rates become less attractive compared to new issues offering higher returns. This typically causes the price of existing bonds to fall, since they now offer a lower yield relative to newly issued securities. Understanding how changes in interest rates affect bond prices is crucial for investors looking to manage their fixed-income portfolios effectively. Soaring treasury yields indicate that the cost of borrowing money has increased. This results in higher interest rates on government bonds and loans for businesses. When you hear about rising treasury yields, it means that the government and other major borrowers are paying more to access funds. Here's a key point. Higher yields make older bonds less attractive. Imagine you have a bond that pays 3% interest when new bonds are now offering 4%. Your old bond looks like a bad deal compared to what's available today. This is due to the inverse relationship between bond prices and yields. When treasury yields rise, existing bond prices typically fall because investors demand higher returns for newer bonds, making older ones less desirable relative to current market conditions. Let's use an example. If you have a $10,000 face value bond with a 3% coupon rate, its market price drops when new bonds offer higher yields, say 4%. The price of your bond might decline to around $8,572, calculated as $10,000/1.04, because investors would rather buy the newer bonds offering higher returns. This drop is immediate but could significantly affect your portfolio's value if you need to sell before maturity. But here's another twist. If you hold on to that bond until it matures, you won't see the price fall impact your return directly because the bond's value at maturity is fixed. However, when you need to reinvest the money from maturing bonds, you'll find yourself getting lower returns because yields have gone up. This is called reinvestment risk. So while the price of your bond might not drop if you hold it until maturity, future investments will earn less due to higher prevailing interest rates. Now let's look at how rising treasury yields affect other areas of finance. Higher borrowing costs can lead to increases in mortgage rates and other lending costs. If mortgage rates rise, homebuyers face higher monthly payments, which could slow down the housing market. This ripple effect is significant because it impacts not just bonds, but also broader economic activities such as consumer spending and business investment. As yields rise, existing bond investments might start to look less appealing compared to new ones offering higher returns. So if you're thinking about your portfolio, it's important to consider that newer bonds may offer better deals right now due to their higher coupon payments relative to their price. But this doesn't mean you should panic and sell off all your old bonds. Investors can use strategies like laddering or barbell approaches to manage risk in rising yield environments. Laddering means buying bonds with different maturity dates so that you receive cash flows at regular intervals, allowing you to reinvest the proceeds into new bonds issued at higher yields as they become available. A barbell approach involves holding a mix of short-term and long-term bonds. Short-term bonds provide liquidity and capital preservation, while long-term bonds offer potential for higher returns but with greater interest rate risk. Here's how laddering works. Let's say you invest in a series of bonds with different maturity dates, such as 1-year, 2-year, 3-year, 4-year, and 5-year bonds. As each bond matures, you reinvest the money into new bonds with similar terms to your initial investment, or take advantage of higher yields if available. This way, you can gradually shift your portfolio to take advantage of rising interest rates without selling off existing holdings all at once. A barbell approach involves holding a combination of short-term bonds for liquidity and long-term bonds for higher potential returns. This strategy can help manage volatility when treasury yields fluctuate, as short-term bonds allow for easy reinvestment in new issues if rates rise, while long-term bonds provide exposure to the higher yields available at that time. Another important factor is reinvestment risk. When your existing bonds mature, you'll likely face lower interest rates compared to current rates, which can eat away at your potential returns over time. However, by using strategies like laddering or barbell approaches, you're better equipped to manage these risks and position yourself to potentially benefit from higher yields when they become available. Soaring treasury yields impact not only bonds, but also the broader economy. When treasury yields rise, higher mortgage rates typically follow, which can reduce demand for homes as fewer people are able or willing to take on larger loans at higher interest rates. This decrease in demand can slow down housing markets, affecting construction jobs and real estate businesses, and potentially impacting local economies that rely heavily on home sales and related activities. The inverse relationship between bond prices and yields is a fundamental principle in finance. When yields rise, bond prices fall and vice versa. This dynamic is crucial for understanding the behavior of bonds in different market conditions and can help investors make informed decisions about their bond investments. To sum up, soaring treasury yields mean higher borrowing costs, making older bonds less attractive compared to new ones offering better returns. This affects not just the price of existing bonds, but also future reinvestment opportunities at lower rates. However, with strategies like laddering or barbell approaches, investors can manage this risk and potentially benefit from rising yields. Now here's a forward tease. What happens when treasury yields continue to rise? Stick around to find out how changes in the bond market impact other areas of your financial life. Higher borrowing costs increase expenses for businesses. When treasury yields rise, companies may postpone expansion plans or reduce spending due to higher borrowing costs. This can lead to slower economic growth, and if interest rates increase significantly, it might contribute to a recession. But let's take a step back for a moment. What does all this mean for your personal finances? If you're planning to buy a home, rising mortgage rates could put the brakes on those plans. Higher interest costs make monthly payments more expensive, which can limit how much house you can afford. This is why it's important to monitor treasury yields and plan accordingly. But remember that we're providing educational information and not financial advice. Now let's look at what happens when treasury yields continue to climb. If yields rise rapidly, existing bonds not only lose market value, but also face a prolonged period of reinvestment risk at higher rates. This can be particularly challenging for investors who rely on steady income from bond investments. Soaring treasury yields impact pension funds and retirement accounts significantly. Many retirees rely heavily on fixed income investments, like bonds, to generate reliable income streams. As yields rise, the value of existing bond holdings typically decreases, making these income sources less attractive and potentially reducing the value if assets need to be sold at lower prices. This can have significant consequences for long-term financial planning. To navigate this environment, investors might consider a strategy called laddering. With laddering, you buy bonds with staggered maturity dates, some short-term and some longer-term. As each bond matures, you reinvest the proceeds into new bonds issued at current yields, thereby gradually extending your portfolio's duration to take advantage of rising interest rates without selling off existing holdings all at once. Another strategy is the barbell approach, where you hold a mix of short-term and long-term bonds. Short-term bonds provide liquidity when needed because they mature quickly, allowing investors to access their capital sooner rather than later. Long-term bonds offer potentially higher returns over time due to their longer duration, which amplifies sensitivity to changes in interest rates. This dual-layered approach helps manage reinvestment risk by balancing immediate needs with future opportunities for yield as market conditions change. Now let's return to how rising treasury yields affect other financial products. Higher borrowing costs mean more expensive loans across the board. Not just mortgages, but also car loans, personal loans, credit card interest rates, and lines of credit. These factors can add up quickly, making it harder for consumers to manage debt and freeing up less money for spending on goods and services. To illustrate this with numbers, imagine you have a bond that pays 2% interest, but new bonds offer 3%. If you sell your old bond now, the price might drop by about 10%, meaning $10,000 could become $9,000. But if you hold on to it until maturity, you'll receive the full face value of the bond, assuming no default risk. But reinvesting the proceeds at lower interest rates can reduce potential returns over time due to reinvestment risk. Rising treasury yields can affect expectations for future inflation. Higher borrowing costs may initially slow economic activity, which could temporarily reduce inflation pressures. However, if high yields persist, they might eventually contribute to higher inflation as businesses raise prices to cover their own increased costs. Now let's dive deeper into reinvestment risk. When your existing bonds mature, you face lower interest rates than current levels, which can significantly erode future returns if you're not prepared. Strategies like laddering or barbell approaches can help mitigate this risk by allowing you to gradually shift your portfolio as higher yields become available. In summary, soaring treasury yields impact bond investments negatively through immediate price drops and long-term reinvestment risks at higher rates. However, with strategic approaches like laddering and barbell techniques, investors can navigate these changes and potentially benefit from rising yields. Now here's another forward tease. How do rising treasury yields affect other investment categories? Stay tuned to find out what this means for stocks, commodities, and more in your portfolio. Soaring treasury yields not only affect bonds but also spill over into the stock markets. Higher interest rates can reduce corporate profits by increasing borrowing costs and slowing economic activity. This often leads to declines in stock prices, as investors become less optimistic about future earnings growth. Therefore, if you're heavily invested in stocks, rising treasury yields might indicate a period of market volatility and potentially lower returns. But let's take a step back again. What does this mean for your retirement planning? Higher interest rates can affect the value of your pension fund or 401k, especially if it has a significant bond component. As yields rise, these fixed income investments become less attractive because their prices tend to fall when yields increase, potentially reducing overall portfolio performance and future income generation from new purchases at higher rates. Now let's look at commodities. Rising treasury yields often lead to higher borrowing costs for industries like mining and energy that rely heavily on capital investment. This can cause commodity prices to drop, as companies may reduce production due to increased operational expenses. For example, gold, which is often viewed as a safe haven asset during economic uncertainty, might see its price decline if investors prefer the stability of government bonds, with rising yields over holding commodities. To wrap up, soaring treasury yields impact bond investments through immediate price drops and long-term reinvestment risks at lower rates. However, by using strategies like laddering or barbell approaches, investors can manage these risks effectively. Understanding this inverse relationship between bond prices and yields is crucial for making informed financial decisions. Now let's explore how rising treasury yields affect other investment categories, such as stocks and commodities, and their impact on your overall portfolio. Stick around to understand the full implications of increasing yields on various aspects of your financial health. Soaring treasury yields can significantly impact bond investments and have indirect effects on commodity markets. Higher interest rates increase borrowing costs for industries like mining and energy, leading companies to potentially cut back on production due to higher operational expenses. This reduction in supply can put downward pressure on commodity prices, particularly metals and fossil fuels, as demand may decrease if economic activity slows. To further illustrate, let's consider gold, a popular safe haven asset during financial uncertainty. As treasury yields rise, investors may prefer the stability of government bonds over precious metals like gold, which can cause gold prices to drop. This shift in investor preferences can significantly impact commodity markets and affect those who have diversified their portfolios with these assets. Moreover, rising treasury yields also influence real estate investments. Higher mortgage rates make home purchases more expensive, which can reduce demand and potentially slow down the housing market. This slowdown can lead to lower property values and decreased investment returns for real estate investors, particularly in areas heavily reliant on new construction and development. Now let's circle back to how these changes impact your overall financial planning. As treasury yields rise, it becomes crucial to rebalance your portfolio to account for increased reinvestment risk and potential declines in bond prices. Diversification remains key. Mixing bonds with stocks, commodities, and real estate can help cushion against the volatility caused by rising interest rates. To summarize, rising treasury yields impact not only bond investments but also spill over into stock markets, commodity prices, and real estate values. Understanding these interconnected effects is vital for maintaining a diversified portfolio that can withstand various economic conditions. Now let's wrap up with one last forward tease. How can you proactively manage your finances in an environment of rising treasury yields? Stay tuned to learn practical strategies for navigating this complex financial landscape. In conclusion, rising treasury yields impact bond investments through immediate price drops and long-term reinvestment risks at lower rates. However, by using strategies like laddering or barbell approaches, investors can effectively manage these risks. Understanding the inverse relationship between bond prices and yields is crucial for making informed financial decisions. Now let's explore practical steps you can take to proactively manage your finances in an environment of rising treasury yields. Stick around to learn how to navigate this changing financial landscape with confidence. This is educational and historical, not financial advice.